Hi, and welcome to Top 10 Finance. And today in this video, we're going to talk about how to invest in the stock market in 2023. And don't forget to like and subscribe for more amazing content. So let's get started. Welcome to the ultimate guide on how to invest in the stock market in 2023, straight from the Oracle of Omaha himself, Warren Buffett. In this video, we'll dive into the mind of one of the most successful investors of all time and discover the timeless investment strategies that have made him a billionaire. With the global economy recovering from the pandemic, rising inflation, and uncertainty in the market, there's no better time to learn how to invest like Warren Buffett. So if you're ready to hear some investment advice that'll help you crush it in 2023, tune in and listen up. Before we go straight into it, don't forget to like this video and remember to subscribe to our YouTube channel for more amazing content. Let's get into it. Background. Meet Mr. Warren Buffett, the Oracle of Omaha, the 92-year-old CEO of Berkshire Hathaway, one of the world's largest companies. But let's be real, we know him because he's the GOAT of investing. Every year he spills the tea on Berkshire Hathaway's returns in a letter to shareholders. And let me tell you, since he took over in 1965, he's averaged a whopping 20.1% return per year, while the market's only managed 10.5%. The total return on Berkshire stock? A jaw-dropping 3.6 million % compared to the S&P 500's measly 30,000%. The stock market took a major hit in 2022, dropping a whopping 20%. To add to the chaos, we're also experiencing sky-high inflation, though it seems to be trending down for now, as well as rising interest rates. The Fed is determined to bring inflation back down to 2%, so they won't stop raising rates until they hit that target. And to top it all off, there's a looming possibility of a decent-sized recession throughout 2023. As an investor, it's a lot to take in. So let's start with the basics. How do rational, long-term value investors navigate a market that's solidly trending down? Number 1. Buffett explains investing in a bear market. Let's say you're a long-term investor trying to build wealth and you're under the age of 55. Here's a nugget of wisdom from the Oracle of Omaha himself. You should want the stock market to go down. Why? Well, if you're still buying stocks, a bear market means you're getting a good deal. On the flip side, if you're in your 70s or 80s, chances are you're selling stocks and hoping the market stays high. But here's the thing. Most people's reaction to a falling market is emotional. We tend to buy when the market is up and panic when it's down. But that's not how smart investing works. As Buffett points out, the stock market is the only place where people run out of the store during a sale. It's like Black Friday but for stocks. And if you're a long-term investor, a bear market is a good thing. Sure, it might be scary to see prices plummeting, but if you've done your research and you believe in the companies you're investing in, then you should be excited to buy more at a lower price. After all, the goal is to buy something you like at a price you like and hold on to it for 20 years or more. Of course, not everyone's cut out for the ups and downs of the stock market. Some people get too emotional and make dumb decisions when prices fluctuate. But as Buffett notes, if you're going to do dumb things because your stock goes down, then you shouldn't own stocks at all. Instead, focus on owning great businesses and remember that market corrections are a normal part of investing. So don't panic when the market falls. Embrace it as an opportunity to buy low and build long-term wealth. Number 2. Buffett explains investing during high inflation. Yes, Buffett's advice on investing during high inflation periods is to improve your earning power and to invest in high-quality businesses with strong competitive advantages or moats. These businesses should have the ability to increase prices easily without fear of losing market share or unit volume. And they should also be scalable to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with an only minor additional investment of capital. Businesses with moats can maintain their pricing power during inflation, which allows them to raise prices on their end products to offset rising costs and maintain profits. Such companies include those with patents, toll collecting companies, powerful brands, and those with built-in cost advantages such as Costco. These companies can come out on top during an inflationary period, as their moat should protect them from suffering a drop in sales. During high inflation periods, it's crucial to invest in businesses with strong competitive advantages, scalable models, and pricing power. It's also important to focus on improving your earning power to keep up with inflation. Number 3. Buffett explains investing while interest rate rises. Warren Buffett once said that interest rates are like gravity to the stock market. Just as gravity holds matter down, interest rates can bring down the value of assets. When interest rates are low, it's easy for both consumers and businesses to access cheap money, leading to more spending, more profits, and more growth. But when interest rates rise, borrowing becomes more expensive, making it tougher for businesses to thrive and for consumers to spend. This creates a challenging environment for businesses to operate in and can lead to poor financial results and falling stock prices. Buffett's advice for investors during high interest rates is to focus on the long term and pick up great businesses at great prices. Though interest rates can cause short-term volatility in the market, stocks are generally a better investment than bonds over the long term. So instead of trying to predict the actions of the Federal Reserve, investors should stay focused on the performance of their selected businesses and take advantage of any opportunities for long-term returns that arise during a high interest rate environment. Remember, when interest rates are high, it's all about playing the long game. As we wrap up, remember that investing in the stock market requires patience, discipline, and a long-term mindset. Take a page from Warren Buffett's playbook and focus on investing in high-quality businesses with strong fundamentals rather than trying to time the market or chase short-term gains. Remember that the stock market can be volatile and unpredictable, but by staying true to your investment strategy and remaining focused on the long term, you can build a successful portfolio that will serve you well in the years to come. Thank you for watching and happy investing. Thanks for watching, and don't forget to like and subscribe for more life-changing content.